Jack, thank you. Welcome, everyone. We have a good crowd. Very excited to have Peter Borsch with us today. He's got a very accomplished background. He's chairman and CEO of Computer Trading Corporation. Peter, you've done a few other number of things in your career. Why don't you give us a little more of your background?
Okay. So first of all, I always start with Michigan because I went there for undergraduate, graduate school, met my wife, my 3 kids went there, my son-in-law went there, so we could talk for 30 minutes about Michigan. But I'll skip that. I was lucky. I came out of Michigan. I got a job at the New York Fed. As I like to say, Wall Street is littered with former Fed people. And out of the Fed, I got recruited by some young guy that was trading cotton on the floor of the Cotton Exchange by the name of Paul Tudor Jones. Maybe a couple of you have heard of him. I was a founding partner at Tudor. I was the head of research. I think you know the history there with 87. I developed sort of the first set of trading models, and so they seeded me, spun out, and I had my own CTA and did that, and then sold that. And so I've been serially unable to keep a job. I was chair of an exchange in Chicago. Thomas Petterfee bought a piece of that. I went on the Board of Trade. The CME bought that. So I'm still looking for some sort of gainful employment. So maybe you guys will have some suggestions. So now, I used to be the young guy, now I'm the old guy, but I was asked to join the board of CIBC, the bank. So now I'm the young guy again, which makes me feel good. And I sit on the board of some startups where I advise some VC funds. One is very exciting. We're creating a whole new marketplace for sovereign carbon securities. We actually just signed our first deal with Bahamas, and so it could be a real business. What I always say about startups, you're kind of 6 weeks from bankruptcy or 6 weeks from being worth $1 billion, and unfortunately it's more the latter than the former. So that's where I am. That's a quick and dirty, and I'm sure you guys have a lot of questions or want to see. And given the volatility of the last few days, from a macro perspective and what we think, and I'm going to leave those questions to you.
All right, great, thank you. So let's start out talking about the economy. I mean, we're coming off some uncertain things with government shutdown, with tariffs. Where do you see things moving at this stage?
Oh, that's a simple question.
That's why I figured I'd start out.
So I just want to give a full disclosure that the right to change my mind starts as soon as I put my tongue back in my mouth, because new information could come out between now and the open 25 minutes from now. But seriously, I think that you have to look at markets, whether you're an investor or you're a trader. And one of the things that I look at from a broader macro point of view is what drives, what drives interest rates. And I think that, can everybody hear me without this? Oh. Round 2. So on a macro perspective, and trying not to get at all, sort of into left-right political or not, what's going to be driving the next 18 months, I think, are the dollar and U.S. interest rates. And I'm afraid that the consensus is that U.S. interest rates are going down. I don't see that at all from the 5-year on. I had the honor of being on Wall Street Week, and I said the most popular job on Wall Street right now is every 3 months forecasting that the Fed is going to cut in 3 months. And it's not there. So now if you look at the broader macro from a trading perspective, I think your best strategy, when markets have a very broad macro low, such as April, and then you have a bounce, people have this tendency to try to do exactly the opposite of what you're supposed to do, which is everybody wants to pick the top and sell high. The reality is, if you look historically, you should be selling those equities that have taken out that April low. So things like Lululemon or Chipotle, and they were both taking out that low before their earnings, and that accelerated. So you have a long-short strategy. So the question is, and we were talking about this before, so we're down. Is the top in? Gossip is fun. I prefer to gossip about sports. I'm a Knick fan. But gossip is not trading. So you need to have a disciplined approach. So in my mind, where we are at the end of this particular cycle, if rates do go up, that's going to put a lot of pressure on these technology stocks because the cost of them issuing all this debt, and they have issued tremendous amount of debt, will go up. Now, we can get into why we think rates are going up and why that is. There's just one little variable in the bill that was just passed, which is accelerated depreciation, which has now incentivized firms to put as much debt as possible on there because that offsets their profits, which have been growing, so then they don't have to pay taxes on that. It can lead to instability.
That's very comprehensive. Let's talk a little bit about the markets. I saw Goldman earlier in the week talked about global stocks are forecast to return 7.7% annually over the next 10 years. Morgan Stanley came out yesterday saying they see a 16% growth in the S&P through 2026. Where do you see things going after this recent bull market? Are we going to continue to move forward, or is it? What do you think?
Well, that's always impressive, right? If you're going to forecast often, my crystal ball gets foggy pretty quickly. So tell me, is the government going to shut down again at the end of January? Where are interest rates going to be? You can look at a little bit, as my old boss used to say, you got to look for snakes in the rock pile. And the dollar has been sneakily getting a lot stronger, particularly against Japan. When you add that up, when you add the uncertainties related, the increased costs associated with tariffs, there's this huge tug of war between deflation and inflation. So before all this started to happen, the stuff that you don't need went down in price, right? Computers, your iPhone, all those sort of related things. The stuff that you do need, healthcare, housing, education, all went up in price. So, and they partially offset each other. Now, if AI is replacing jobs or the rate of growth of wage increases, that's going to put increasing deflationary pressure. And that's the irony of sort of my global view, that people think, well, if you have increasing deflationary pressure, rates have to go down. But they don't have to go down because supply and demand still works in economics. And if our debt level is going up and it's accelerating, right? So trading is a second derivative, it's not a first derivative. That puts additional pressure on who's going to be buying our debt. And the flip side of a trade deficit is a capital surplus. And if we are getting to the point where a lot of our trading partners don't want to hold our U.S. debt, that's another dynamic to raise. And I'll just ask a question. If you were investing today, what's a better credit? Apple, Microsoft, Google, or the U.S. government?
Yeah, it's a good question. Let me, speaking of questions, we'll have time at the end too, but if anybody, has a question now, or please let us know. We've got a mic, we can get people to it. So interest rates, the Fed, every 3 months, what's going to happen? We waited a long time for this one.
Yeah, so when you think of trading decisions, and you have to put risk management around that with a level of uncertainty. So what do we know? We know Chairman Powell is leaving. We know that there's tremendous political pressure to try and reduce short-term rates, which is why I said from 5 years out, rates are going to go up. So we don't know who the next chairperson is going to be. That's a big uncertainty variable. We don't know. So President Bostic is leaving Atlanta. Okay, who's that going to be? So this uncertainty is not good for markets, and that's another sort of push for raising rates. Now, if you want to look back at history, and so, by the way, this is one of the things I'm really good at is I'm a keeper of huge insignificant information. So in 1973, the high for the stock market was October 29th. Anybody want to tell me what the day of the high was so far this year? Obviously, October 29th. Okay, so what now? The other insignificant information is how many people read online and get all their information that November is by far one of the strongest months of the year. Okay, now do we believe markets are discounting mechanisms? Of course, if everybody knows that, they buy ahead of time, which is one reason why October was so strong. So technically, in this little correction right now, you want to look at the October 10th low. If that holds, then the uptrend may still be there. If it penetrates it and closes below it, that would be a first sign of potential larger magnitude correction in the markets. So 1973, very similar. And that's what makes me a bit nervous because Nixon tried to take control of the Fed, and they tried to monetize at that point the higher energy prices that came out of the Yom Kippur War, and unemployment was going up, inflation was going up. They tried to monetize that. Interest rates really started to take off, which then led to 1980 with Volcker coming in. Just a little bit more insignificant information, so I can bore you to death. Interest rates run in very, very long cycles. Following World War II from 1944 to 1982, we had a 38-year cycle of rising rates. And like most market moves, they happened at the end, the largest increase. From 1982 to 2020, 38 years, we had declining interest rate cycle, and the largest moves, of course, happened at the end. So if we're in a longer term macro cycle, we're just in the early stages of rising rates.
Interesting. Let's move on to gold and silver. They've been moving up. Where do you see those moving forward in the economy right now?
So if you're concerned with uncertainty, gold is better, I think, than either crypto or silver. And by the way, I'm such a fan of, the popular press, right? Silver just took out its 1980 high 45 years later, and everybody's throwing a party. That would be the equivalent of the Jets winning something, right? I mean, you should not be throwing a party because a market made new highs after 45 years. So you have to look at the perspective, what the real value of silver is, what that is relative to the S&Ps. So in a world of potential uncertainty, I think gold is better, though I think right now, if liquidity is an issue, and you're seeing that. So I have this whole presentation on trading and everything, but I can tell you this, the only thing that goes up when all hell breaks loose is correlation. So you're seeing, right, the equity market's gone down, gold, crypto, everything.
Interesting. So speaking of commodities, you were very involved in commodities in some part of your career. What's the 7 C's? I've heard the 7 C's. Is that a model of yours?
Yeah, well, I used that's pretty good, actually, that you brought that up. I use the 7 C's as sort of an indicator of inflation or deflation, and right now we're in this tug of war. So the 7 C's are crude, corn, copper, cocoa, cattle, coffee, and did I say 7 or 6 there? Corn. Corn. So they all give you an indication, right? So think about this. Again, this is the irony of markets. So we're trying to reach some sort of accommodation with China. China says we're going to go buy soybeans, which pushes corn up, which pushes wheat up. Those are inputs into the CPI. So ironically, right, we're trying to reach this deal, measured inflation is going up. Cotton has been very weak, so corn has been rallying. Crude we all know about, which has been sort of weak, lower end of its range. Copper's been rallying, partially because of the demand for data centers and everything else. So there's, and cattle, we all know, right, if anybody's gone to get a burger, we know how expensive
Yep.
beef has become.
Interesting. Let's talk about risk in the markets. Where do you see some of the largest areas of risk and what's going forward here?
So, well, there's 2 types of risk. That's why I said if you're a trader or you're a long-run investor. So if you're, my kid's age and you're starting your career and you got a 50-year horizon and you believe in the U.S., then you just sort of do your 401k and put it away. If you're in this room and you're more of a trader, then you have to ask yourself, I need some disciplined approach for risk. And whatever that is, don't pick a top. So I'm not wearing those cufflinks today, but I was on TV this week and I was wearing my Superman cufflinks. And I said, unless you're Superman and you're more powerful than a locomotive, you should not try to get in front of a freight train.
Yeah.
So gambling and trading are 2 different things, even though a lot of it is intersecting. So we have NVIDIA coming out tomorrow. Unless you have inside information, and if you do, come talk to me after. Right, I don't have a clue whether it's going to move up or down. I have, depending on some technicality. So having a big bet on that is risky. If I'm long and I've had some great profits, then maybe I want to sell some calls to protect it, or I want to buy some puts. But the risk management is a disciplined approach. And that is not, watching TV and listening to idiots like me tell you what to do, which I'm happy to do, by the way. And you get what you pay for, which is free advice. So you have to have your own disciplined approach. Risk right now, because of the high correlations among everything, don't think you're diversified, because it might be the same position in 10 different ways. So in periods of uncertainty, have smaller positions, trade smaller, and I think we all know that the pain of losing money is far greater than the joy of winning.
Yeah, I would agree. So we talked a little bit about AI, and there's been an incredible amount of investment in AI. Where do you think that can that keep going up? And with all that investment, how is anybody going to get a return on that over time?
So that's a loaded question. So Wall Street is really great at one thing. If there's the demand, they will create supply. You want a SPAC? We'll give you a SPAC. You want to invest in an AI startup, we'll give you AI startups. The technology, we all know, is amazing. Technology advances far more quickly than people can adapt to it. We've seen that over the past century, starting from radio and cars and the internet and SaaS. So there tends to be over-investment and then a significant correction. So there's two separations here. Is the technology going to be used and adopted by everybody? I would say yes, most likely. You know, when I was back at Tudor in the early 90s, and I was one of the first people to create a domain name, and they were like, well, what do I need email for? I have fax, right? Because there was not the social media, you know, the network effects of everybody having it. Once they have it, it's obvious, right? So after the fact, everything is completely obvious. So AI is going to change things. Is it going to predict the future? No. And by the way, I will test my skill with anybody in the world about predicting yesterday. I think I'm really good at that. Unfortunately, from trading and a risk management point of view, it's that uncertain tomorrow. And as we were talking before, Ken Griffin says they're great tools, but they haven't been alpha generators yet.
Yeah. But it's amazing the amount of investment, and the investment in data centers, and the investment in what the infrastructure for that needs to be, and where that spending is, and the investment in and the need for the amount of electricity to generate all that. I don't see where that's all going to come from in a short period of time. What do you think?
That's part of the tug of war of rising inflation, substitution effects, so you have relatively demand and elasticity associated with that. So those costs go up, so there's going to be a substitution of discretionary thing, which is maybe why sweet greens and kava have gone down. And at the same time, the demand for all that is another push for higher interest rates. And you know, the greatest element of creating supply, of course, is high prices. So we will develop it, but prices could be significantly higher.
Interesting. We're getting down a little bit toward the last couple of minute mark. Are there any questions? We got a bunch of people here. There's a question over here.
Thank you very much. Question is, you know, we're seeing a lot of growth, a lot of conversations around the growth of the DeFi space, the decentralized finance space, and what are your thoughts using your fuzzy, or I think you mentioned your cloudy crystal ball, on where does, like, say, the future market structure look like between, let's say, traditional finance and decentralized finance?
I figured someone would ask that question. The short answer is, I think like everybody else, I'm kind of clueless. Being on the board of a bank, the issue is when things are going well, as they have been, people are more willing to experiment. And when they're not going so well, they kind of run home, which is why I said I think the dollar has been sneakily strong. So the distinction between finance and, for example, blockchain and tokenization, that is going to be fascinating in a world of transaction because it's much more secure from a ledger point of view if you're moving products around to track it. I'm not a big bull on the substitution effect of DeFi for transaction-based purchases. Because in my mind, and you can go back to this, whether it's gold or silver or Bitcoin or anything else, if you, in your mind, if you're always going back to its dollar value, then you're going to end up using dollars.
That would lead us to the stablecoin question. The governments are putting so much effort on it, and us, the public, my opinion is we prefer Bitcoin. So stablecoins versus the old coin. What do you think?
From a risk management point of view, stablecoins make me very, very nervous because it's kind of good for government because you have people holding sort of implicit interest rates instruments that aren't inherently paying a rate. But if you get some instability in that shorter end of the curve, that becomes a problem. And I don't know the answer to this. What's the embedded leverage that all those stablecoin issuers are offering? And the one thing history has to offer, whether it goes back to gold at the end of the 80s, go back to the 87 crash, go back to 01, 03, or 08, it's all embedded too much leverage. And we can argue that the funny thing that happens at the end of cycles is kind of the repeal of Dodd-Frank because nothing bad has happened, so the assumption is that nothing bad will happen, is a concern from a risk management point of view.
Thank you. So it seems like we all kind of agree passive might have ruined the markets. If you're designing funds and you know that most of the money is just indiscriminately buying the largest market cap companies at any price, how do you trade that? What do? Do you just go with it?
I'm laughing because, as I said, I sit on the board of a bank and we have to determine how we compensate our portfolio managers. And are they idiots for underperforming, or are they geniuses for being disciplined? And of course, as an investor, you're always measuring against a cap-weighted S&P. And so I think from a risk management point of view, you should not be chasing, because obviously every day a stock goes up, its weight in the S&P goes up, and so it's the exact opposite of what we were all taught, which is buy low, sell high. Here you have to buy high and hope it keeps going up. So you have to have a strategy, like if you're underweighted in these things, what happens so you need to pregame, right? You got to be a good coach, and if it pulls back, am I going to add to exposure? So I'll just sort of say, here's my definition of a quandary. Do you stay out of a market and watch everyone else make money, or get in and thereby cause it to immediately crash? And we all have that feeling. So you need to have some exposure, but history matters. So if you go back, and again, insignificant information, if you take the top 10 market cap stocks from 79, 89, 99, 09, too soon for 19, how many of them were still in the top 10 a decade later? On average, it's only 2 to 3. So you need to have some exposure, because you don't know which 2 or 3 it's going to be, but don't think that you can just buy something and go away forever. In the mid-'80s, it was IBM had the largest market cap. Then we had ExxonMobil. And in the late 70s, anybody remember a company by the name of Eastman Kodak? That was a top 10 market cap. So, as I said, looking backwards, I'm a genius. Going forward, it's a lot tougher.
All right, one more, or we're just about out of time? All right, very good. Thank you, Peter.
No,
Appreciate it.
thank you. Thanks for having me.